Perhaps the most widely used method of momentum interpretation is the evaluation of overbought and oversold levels. This concept can be compared to a person taking an unruly dog for a walk on a leash. The leash is continually being pulled from one side of the person to the other as the dog struggles to get free. Despite all its activity, however, the dog can move no further away than the length of the leash. Please excuse this lousy cartoon, but I think you get the point. The same principle holds true for momentum indicators in the marketplace, except that the market's leash should be thought of as being made of rubber. That's because it's possible for particularly strong or weak price trends to extend beyond the normal limits known as overbought and oversold levels. Here's a typical oscillator or momentum indicator. So let's start off with the point of balance, the halfway or equilibrium point. Then we can draw in another horizontal level, one where when touched the probabilities favor a decline. This is the overbought zone. Now at the other extreme, where the probabilities favor a halt to the decline, we can mark in the oversold zone. Think of the equilibrium level as the guy and the overbought and oversold levels as the dog at the end of the leash. The actual boundaries of the extreme levels would depend on the volatility of the price being monitored and on the time period over which the momentum indicator has been constructed and the nature of the construction of the momentum indicator in question. For example, a rate of change indicator has a tendency to move to wider extremes over a longer period than over a shorter one. It's highly unlikely that a price will move 10% over a 10-day period. Yet over the course of a primary bull market extending over a 12-month period, a 25% increase would not be uncommon. Some indicators, such as RSI and stochastics, have been specifically constructed to move within definite predetermined boundaries, so this is not a problem for them. When an oscillator reaches an overbought or oversold extreme, the probabilities favor, but by no means guarantee, a reversal. An overbought reading is a time to be thinking about selling, and an oversold one warns that the current technical position may warrant a purchase. Here's a newspaper boy, and he's bringing some pretty good news. The guy reading the newspaper is saying to himself that the news is so good, I'm certain to make money if I buy now. Unfortunately, that's exactly the time when the price is overbought. What has happened is that the market, in the form of more informed market participants, has already anticipated the good news, and this has been factored into the price. So when the good news is widely disseminated, they start looking for someone to sell to, and that's our guy reading the newspaper. It's not that he's dumb, it's merely that he's the last to get the news. That's why in many cases, when a price reaches an overbought extreme, the news is good, participants are optimistic, and human nature tells us to buy. Unfortunately, the opposite is more likely to be the case. I don't regard an overbought reading as a signal to sell, unless the other indicators have also gone bearish, but it's certainly a place to think about taking partial profits, as the odds favor a digestion of gains. On the other hand, an oversold reading is usually associated with a negative news background. The last thing we want to do at such times is to raise our shaking hand, pick up the phone and call our friendly broker and tell him to buy. But that's often a reasonable time to do it, provided the overall technical position is favorable. In this instance, our latecomer is saying that the news is so bad only a fool would buy now. Well, of course, the answer is that others have anticipated the news and have either sold or have held up their purchases until the bad news is out of the way. Once again, if you have a short position, it's a good idea to cover part of it. Alternatively, if you're a buyer, buy a little now and more later when you get additional evidence that the trend's reversed. Before we move on, I'd like to introduce you to the rate of change so that we can better appreciate some of the interpretive techniques in a more practical way. The rate of change is probably the most simple of all momentum indicators to calculate. To some people, simplicity is an impediment, since they feel that only complicated stuff works, but nothing could be further from the truth. Indeed, I believe that one of the golden rules of technical analysis should be, don't cast away an indicator because it's simple, reject it because it doesn't work. Far too often, we follow indicators that are difficult to calculate and near impossible to interpret. In effect, we're using complicated approaches and indicators as a crutch for not thinking. Far better to try and understand the underlying psychology of what the charts are telling us about crowd psychology. If the ROC indicator is rising, the difference between the current reading of the price and its level 10 weeks ago is growing. So here it is at its maximum, where this close is being compared to this one. If the ROC is above the equilibrium line but is declining, the price is still above its level 10 weeks ago, but the difference between the two readings is shrinking. When the ROC indicator is below zero and falling, the price is below its level 10 weeks ago, and the difference between the two is growing. If the indicator is below its central line but rising, the price is still lower than its level 10 weeks ago, but the rate of decline is slowing. In short, a rising rate of change indicator implies expanding velocity, and a falling one implies a loss of momentum. Rising momentum should be interpreted as a bullish factor and declining momentum as a bearish one. Choice of the correct time span is important. Don't start expecting the Holy Grail because it doesn't exist. However, the following are suggested as offering reasonable results for monthly, weekly, and daily charts. For monthly and weekly data spans, embracing calendar quarters appears to work quite well. 9 months, 12 months, 18 months, and so forth. And they're equivalent in weekly spans. 39 weeks is the same as 9 months, 200 days is also about the same period, and offers a similar concept. I also like 45 days, although I didn't include it in the table. It's important to remember that the analysis of any technical situation will be enhanced by the calculation of several momentum indicators, each based on a different time span. In this way, trend lines, price patterns, or divergences, which may not be apparent in one period, are more apparent in another. The discovery of signs of a trend reversal in several indicators constructed from different time spans adds further fuel to the weight of the evidence. When I talk of differing time spans, I do not mean to compare a 10-day to a 9-day, as that will basically be the same. Rather, a 10-day to a 20-day, perhaps even a 30-day, and so forth. You'd be surprised what technical events will show up in one span that you cannot spot on a second. Sometimes they're all saying the same thing. Then, remembering the weight of the evidence approach, you've really got something. In view of the variability of the volatility of differing securities, there is no hard and fast rule about where the overbought and oversold line should be drawn. This can be determined only by studying the history and characteristics of the security being monitored for any given rate of change time span. The lines should be drawn in such a way that they will act as pivotal points which, when touched or slightly exceeded, are followed by a reversal in the oscillator. When a particularly sharp price movement takes place, normal boundaries will become totally ineffective. But unfortunately, this is a fact of life. But it's usually possible to construct overbought and oversold benchmarks that are reasonably price sensitive. Remember, the market leash is made of rubber and can remain in overbought or oversold territory for long periods. Consequently, it's essential to get confirmation from a reversal in the trend of the price itself before taking any drastic action. I'll draw a couple of lines on this chart, and you can see that they're so close together that when the oscillator touches them, the event is really meaningless. On the other hand, here are another set of lines, and these are clearly too far apart. If the oscillator can only touch them 3 times in 11 years, they're really not very actionable. Finally, this chart shows a more balanced approach, where the lines are touched more often. When they are, or the lines are recrossed on their way back to zero, the probabilities of a trend reversal are much greater. Note that all these lines have been drawn equidistant to the equilibrium level. plus 25 or minus 25, plus 12.5 or minus 12.5. That's to make things balance and better reflect the dog on the leash analogy. This chart shows a 30-day rate of change for silver. The plus and minus 10% levels seem to fit the overbought, oversold requirement quite well.